knock off each other.
People are seeing this, and those memories of fear are coming back.
Gamble. Proctor's trading at 60.
I asked them what the heck is going on down here. I don't know.
All of a sudden here, we started hearing screaming, buy, buy, buy.
Right now, we're sitting down 875 points.
We've now broken Dow 10,000.
The Dow Jones Industrial Average dropped more than 900 points.
The market didn't work. It broke down. The machines broke down.
Fear came back into the market in a very big way.
Subprime Nightmare, a financial horror story. Introduction. The subprime mortgage crisis, also known as the subprime meltdown, was a catastrophic financial event that triggered the Great Recession between 2007 and 2010. It was a period marked by widespread foreclosures, bank failures, and a severe economic downturn. This comprehensive exploration delves into the origins, development, and aftermath of the crisis, shedding light on how it unfolded, who was responsible, and the profound impacts it had on the global economy. Section 1. The Prelude to Disaster. Understanding mortgages. At its core, a mortgage is a loan used to purchase real estate, where the property itself serves as collateral. Mortgages are typically long-term loans, with repayment periods ranging from 15 to 30 years. The borrower agrees to repay the loan in monthly installments, which include both principal and interest. If the borrower fails to make these payments, the lender can foreclose on the property, selling it to recover the loan amount. The rise of subprime mortgages. In the early 2000s, the U.S. housing market experienced an unprecedented boom. Homeownership was heavily promoted, and lenders began offering subprime mortgages to borrowers with poor credit histories. These loans were characterized by higher interest rates, reflecting the increased risk of default. The rationale behind this risky lending practice was the assumption that housing prices would continue to rise, allowing borrowers to refinance or sell their homes at a profit. Securitization played a crucial role in this environment. Banks bundled these high-risk loans into mortgage-backed securities (MBS) and sold them to investors. These securities were often given high ratings by credit rating agencies, despite their underlying risks. This process spread the risk across the financial system, making it seem manageable and encouraging further lending. Section 2. The Unfolding Crisis. The perfect storm. As more and more borrowers took out subprime mortgages, housing prices continued to soar. This created a speculative bubble, with people buying homes not just to live in, but as investments. However, by 2006, housing prices began to decline. Many borrowers found themselves underwater, owing more on their mortgages than their homes were worth. This led to a surge in foreclosures, as borrowers could no longer afford their mortgage payments or sell their homes for a profit. The wave of foreclosures caused the value of mortgage-backed securities to plummet. Financial institutions that had invested heavily in these securities faced massive losses. The crisis quickly spread beyond the housing market, affecting the broader financial system. The domino effect. The collapse of major financial institutions highlighted the interconnectedness of the global financial system. Bear Stearns, a leading investment bank, was one of the first casualties. In March 2008, it was sold to J.P. Morgan Chase at a fire sale price, with the Federal Reserve providing financial backing. The situation worsened in September 2008 when Lehman Brothers, a 158-year-old investment bank, filed for bankruptcy. This event sent shockwaves through the financial markets, leading to a credit crunch. Banks and financial institutions were reluctant to lend to each other, fearing further losses. This freeze in the credit markets affected businesses and consumers alike, leading to a sharp decline in economic activity. The stock market crashed, wiping out trillions of dollars in wealth, and the global economy entered a severe recession. Section 3. The Aftermath. Government Intervention. In response to the financial meltdown, the U.S. government implemented a series of emergency measures. The Federal Reserve cut interest rates to near zero and provided liquidity to the banking system through various lending programs. In October 2008, Congress passed the Troubled Asset Relief Program (TARP), authorizing $700 billion to purchase toxic assets and inject capital into struggling financial institutions. These interventions helped stabilize the financial system but were controversial. Critics argue that the bailouts rewarded the very institutions responsible for the crisis while doing little to help ordinary homeowners. Nonetheless, these measures were deemed necessary to prevent a total collapse of the financial system. The human toll. Beyond the financial markets, the crisis had a devastating impact on millions of Americans. Families lost their homes to foreclosure, and personal savings were wiped out as stock markets crashed. Unemployment soared, with the jobless rate peaking at 10% in October 2009. The economic downturn led to widespread hardship, with many people struggling to meet basic needs. The human toll extended beyond the United States as the crisis triggered a global recession. Countries around the world experienced economic contractions, increased unemployment, and social unrest. The crisis underscored the interconnectedness of the global economy and the far-reaching consequences of financial instability. Section 4. Lessons learned. Regulatory reforms. In the wake of the crisis, significant regulatory reforms were enacted to prevent a similar catastrophe in the future. The Dodd-Frank Wall Street Reform and Consumer Protection Act, passed in 2010, aimed to increase oversight and transparency in the financial system. Key provisions included the creation of the Consumer Financial Protection Bureau (CFPB) to protect consumers from predatory lending practices, and the implementation of the Volcker Rule, which restricted speculative investments by banks. Additionally, the Financial Stability Oversight Council (FSOC) was established to monitor systemic risks and promote financial stability. These reforms sought to address the weaknesses in the financial system that had contributed to the crisis and restore confidence in the markets. Ongoing challenges. Despite these reforms, challenges remain. The housing market has recovered, but issues such as income inequality, housing affordability, and financial literacy continue to pose risks. Furthermore, the financial industry has evolved, with new technologies and financial products emerging that may present unforeseen risks. It is crucial to remain vigilant and ensure that the mistakes of the past are not repeated. Continued oversight, transparency, and responsible lending practices are essential to maintaining financial stability and protecting consumers. Conclusion. The subprime mortgage crisis was a financial horror story that left deep scars on the global economy and millions of individuals. By understanding this chapter in history, we can work towards a more secure and equitable future. The lessons learned from this crisis are invaluable, reminding us of the need for robust financial regulations and responsible lending practices. This comprehensive exploration of the subprime mortgage crisis highlights the importance of vigilance, transparency, and accountability in the financial system. Thank you for exploring Subprime Nightmare, a financial horror story.